I'm more looking at it from a top-down macro perspective. And if you just like take a step back in terms of where we are in this overall tightening process, like the U.S. economy is running too hot, inflation's too elevated, it's above the Fed's mandate, it's not on a clear path to fall to the Fed's mandate. And the Fed has actually like made a pretty good amount of progress on changing the price of credit, right? The price of credit, meaning how much does the incremental borrower have to pay to borrow? The answer is like a lot, like if you get a mortgage, you print a mortgage today, it's almost 8%. If you go get an auto loan, you're paying 8%. If you're, I don't know, even a company issuing a newly minted, syndicated loan, you're looking at, 10%, 12%. That's very high, and that is hard. But the problem is that asset prices haven't come down. And that's a really important thing to think about, which is when I look at high yield bonds and I look at those prices, and particularly if I look at the spread return, right, not just the treasury component, but the spread, I look at that and I say, well, that's basically at highs, right? That's basically, because you're getting the yield on the spread and the prices haven't, the spreads haven't widened that much. In fact, they're kind of normal. Same thing is true in equities, right? Which is that stocks right now, basically at all-time highs. They're not far off of all-time highs. And typically in a recession, what you see is stocks fall like 20, 30, 40%, right? Like that's when stocks move, right? Not, 5% off the highs. And so if you think about and I should also mention that houses for the everyday, the everyday person who owns their home are still up like 40% relative to pre-COVID. So okay, put that all together, and the balance sheet of households, of investors, is basically as strong as it has ever been. And that is creating a circumstance where they're not being pressured to curtail their spending because asset prices are rising, and so they can continue to save. Or if you want to go buy something, I mean, the reality is how are house prices so elevated at a time when mortgage rates, would imply that you have to pay twice as much for, a monthly payment than you did 2 or 3 years ago? And the answer is what people just pay cash, right? It's not that complicated. Like if I have a bunch of equity wealth that has been built up through these elevated equity levels, I just sell the equities, I pay for cash in the house, and boom, there you go. I've got, I can pay the higher cost of things. And so I think that's when you sort of put the whole macro dynamic together. Like the Fed has solved the price of credit problem, but it hasn't solved the asset price problem. And that until they solve the asset price problem, or it gets solved on its own through market conditions, which is probably the more likely path right now, we're not going to have a meaningful slowing of the economy, and the Fed will not get the economy back to where it needs to go consistent with its mandate.